Many thanks, George, and welcome to the concluding session of Ethical Finance 2021. I'm very pleased to say we're talking to one of the world's leading sustainable finance experts, Hiro Mizuno. Hiro is well known as the former Chief Investment Officer of Japan's Government Pension Investment Fund, during which time he became an outspoken advocate for ESG investing and an outspoken critic of short selling. Since leaving GPIF, he's taken non-executive roles at Danone and Tesla and is the United Nations Special Envoy on Innovative Finance and Sustainable Investments. Hiro, welcome. Thanks for joining us.
Well, thank you, George. And it's my real pleasure to speak at this event. And my thanks goes to Global Ethical Finance Initiative. So thank you for having me.
Excellent. Well, maybe we could start by referencing your time at the GPIF. While you were there, you warned that asset managers that took GPIF business, they would receive smaller checks if they didn't exhibit good governance, and that was all the way back in 2017. Do you think fund managers do a lot better on ESG issues in 2021?
Well, sure. Of course, they do it better as the time. You mentioned we are still fighting over the relevance of ESG factors as an investment of financial information, and there is also the battle if the ESG is just representing the my value, or just it's a my value statement, rather than financial analysis or decision-making information. So compared to that time, now I think it's become almost politically incorrect to argue against the ESG. So it's now very hard to come across somebody in our industry who really says like, I don't care about ESG, right? So from that, the perspective, obviously, there's a big progress made, between the time I started and now. When I first, came to GPIF asset managers asking, what do you think is your responsibility as the fund managers? And the most common reaction or response to me at that time was, "Oh, Mr. Mizuno, our role is for active manager deliver you alpha, and a passive manager tracking the index with lowest tracking error and possibly at the lowest cost." Yeah. And then my journey started by questioning them, like, okay, so who's actually feeling responsible about their ownership? So GPIF is in the investment chain, called themselves and also called by others the biggest asset owner in the world. But the way we manage the fund is basically we outsource all the other fund to external asset managers, right? And those asset managers say, "Oh, we are just the agent, and we do what I just described for the benefit of GPIF." And then my question was, okay, who is exercising ownership? Who is trying to be responsible as an owner? Because ownership should come with the responsibility, right? That's obvious in any part of our society. So that's exactly what how I started. And throughout that discussion, we reached the point saying like, okay, if the asset manager doesn't agree that the importance of the long-termism and being represented in ESG, the factors, if they don't take it as a major part of their, the asset management practice, for GPIF, we should question that whether you have aligned interests with us. And then you step on to like, basically, even if you deliver the same extra return, in other words, alpha, or even if you, track the index perfectly, if you don't step up and play the role as the sort of like asset owner, because we entrust them with all the voting powers and etc. So then we will just revise our contract with you. So just to answer your question a bit a long way, is that just a reflection of, the thinking about through the system we use, the investment chain, where the responsibility, resides, and in the principal agent relationship, which role and which responsibility they should be held accountable. So that's where it was, yeah. And I think that part.
I suppose just in terms of, I mean, you raised the important part about asset owners. Do you think enough different asset owners are taking the path that you did at GPIF? Do you see that happening to your satisfaction?
Yeah, well, I think the most of the sizable and asset owners, they usually manage their portfolio mostly themselves, and so that kind of agency issue of the sort of what I call the vacuum of responsibility or non-existence of ownership, sense of ownership, does exist much less. And you can observe that a lot of like big asset owners now becoming more and more vocal, more and more active. What they are expecting from their portfolio companies, not only the financial return or dividend, but also they expect the appropriate portfolios, the companies to perform or deliver, to serve the much higher level purpose of the fund managers or asset owners. So in those groups, it's easier to observe. It's easier to address. But in the GPIF, the case, and also the majority number, less sizable, less resource asset owner who has to depend on the asset manager as an agent, I think the situation remains very difficult to address. So I think the GPIF trying to be a pioneer, trying to address that agency problem. Right.
And I mean, the biggest asset manager, BlackRock, we saw them voting with Exxon's activists last week, which was quite a big move. And that kind of, and they've clearly kind of set out their stall as wanting to take environmental issues in particular seriously. But recently we also saw 15 US state treasurers saying they wouldn't be handing out business to asset managers that that just kind of don't do enough financing for existing fossil fuel players. So there's a kind of tension there. Do you I mean, and it's a kind of something happening in America as well. Do you worry that America as a capital market is still a bit behind the curve compared to Europe or on ESG issues?
Well, I think it's not like a black or white type of the answer I can give to your question, but just take Japan as an example. European think Japan is also behind the curve in terms of like the environmental issue, given Japan's dependence on a coal for their, the energy mix. The one thing I just wanted to emphasize here is, when we talk about the ESG and the performance or like ethics or morale or the value in the financial decisions, the most common, sort of like a defense, the conventional minded investor or financial professional uses as a counter argument of fiduciary duty. And I always say like a fiduciary duty, if you interpret that in the more common language, that means you have to loyal to your customers, right? Yeah. So I can understand that the in some states in America where like a fossil fuel is a major industry, they will say like if the asset manager I give you money and the manager we give money to, basically voting against those companies, they feel that's against they don't have a loyalty to their customer. That's understandable, right? So the one thing is like first of all, I always think that they really need to rather than just using fiduciary duty as an easy defense or easy like the easy line of defense, they should just talk to or face the what their the beneficiaries, what their customers. And then now I think it's becoming more and more global agenda that the if we fail to address climate change, we are going to have the massive negative impact on the portfolio, whatever you have, right? So so I think BlackRock, the recent change reversal on their stance on those like the proxy voting, probably reflecting majority of their clients base is now thinking if the asset manager continue to act in the way they previously acted, it's probably not really supporting their future sustainability or future, the viability of their money, of their portfolio fund, whatever you call it. So I think that's actually what's happening. So the more customer, the more societal consensus about those issues, the asset manager, again, they are agent. So sometimes they try to sound like they are a principal, but they are agents. So if they fail to reflect what the principal is hoping for, that's really against the fiduciary duty, right? So I think in Europe, what I observe is, even compared to Japan, there's much more solid consensus among the community. Yeah, those issues must be addressed by the government, also by the businesses. And when they expect the business to address those issues, they obviously expect the investor to accelerate it rather than stopping it, right? Yeah. So I think in the US there are still much less sort of social consensus on the community level consensus on that issue. Yeah. So we just cannot judge by how the particular industry player acts, because at the end of the day, that these climate change. Well, this is again what I really advocated when I was a GPIF CIO. Whatever I do as a CIO, tilting the portfolio, changing the manager, at the end of the day, the long-term performance of the fund is much more, the vulnerable to the global climate change.
Absolutely, yeah, that's very interesting. I mean, it's a difficult one for the likes of BlackRock to a balance to strike between their stakeholders who want them to push more on ESG issues and the state treasurers I was talking about. It's a difficult balance one. But this is a kind of even wider question, but it refers to the fact that you sit on this thing at Danone called the Mission Committee, which is a really interesting and kind of way to kind of legally enshrine environmental and social considerations into their objectives on top of shareholder value. But that's really kind of the question, like, how do you combine those two things, the imperatives to generate economic value and kind of observe environmental and social considerations? And would you say that shareholder value and ethical considerations are now of equal importance? Because they certainly didn't used to be.
Yeah, well, I think that's probably my ultimate message to the audience today is basically like, most of us used to believe that, the ethical, being ethical and being profitable as a business are sort of mutually exclusive. Mm. So when I started advocating the ESG consideration, another most common pushback saying like, oh, how do you explain about the trade-off? Mm. And my reaction was, first of all, there is no evidence those are trade-off relationship between those two, but we are kind of like a prejudiced, those are the mutually exclusive or a trade-off relationship. So I think that's something that people start questioning. And the more we got deeper into the ESG analysis, the ESG research, it's becoming also very evident. The ESG the consideration is actually improved the financial return. So 5 years ago, obviously, when I started, even academic research had us showing very mixed result. Right. Some of the research showed ESG is actually negative attribute, and the other says positive attribute. Now, if you keep an eye on all those researches done by academics and also the financial research company, it's becoming more and more clear those ESG factors are positive consideration to the financial performance for long term, right? So talking about Danone went extreme by changing the article of incorporation and utilizing the French new legislation to create a company who serves multi-stakeholders, not only shareholders. So the way in the past and outside of Danone, the way I try to persuade the investors or shareholders to look after the ESG issues is, if the company failed to address those ESG issues, long-term financial value of that investment will be damaged. That's why talking about and the making sure corporate executive CEO takes care of those ESG factors are beneficial for long-term investor. That's how we kind of explain and persuaded the shareholders act on ESG. And Danone went even further, saying, hey, our company is set up to serve multi-stakeholders, right? So first one, kind of trying to just they make the case through the shareholders value argument. The Danone's case is basically this is how our company is set up, right? But at the end of the day, we need to achieve both, right? Because if the CEO continue to fail to deliver the performance, I'm not talking about short term, but the reasonable time frame. Well, it's understandable shareholder lost the faith in that particular management. But at the same time, if let me put that this way, the reason why I really like the idea of Danone's a new corporate, the enterprise mission or the other activism by the long-term asset owner is, ESG is something most of the CIO is not naturally incentivized to commit to, because the climate change, in many cases, if they really wanted to address the climate change, they may hit their bottom line negatively in the short term because they need to make additional investment, and they need to get rid of some a cash flow positive operation like a coal and those kind of things, right? And Exxon is actually facing that situation.
Exactly.
The investor telling them not to expand the cash generative business, right? The cash cows, right?
Absolutely.
So that one is CEO is not naturally incentivized. Look at the agenda diversity. Everybody understand now the importance of diversity on the board or in a management team, but adding the one or two the female board member probably wouldn't improve the performance of the company for the next 6 months or the 1 year, right? So that's again, CEO is not financially or naturally incentivized to address those issues. So that's where the governance should kick in, because corporate governance should be responsible for something which the CEO is not naturally incentivized.
Right.
Particularly, the keeping the eyes on long-term agenda, because most of the ESG agenda, goes beyond incumbent tenure, right?
Exactly.
So I think that's the way I see the sort of the balances.
But I mean, and that longer term governance issue is completely critical. But how do you kind of combine? What do you do when you get a situation? It's not dissimilar to what Danone is a specific situation, but there was you had some kind of hedge funds who were more focused on the short term performance, and the incumbent CEO Emmanuel Faber was seen as a kind of real champion of ESG issues. So there's a quite difficult balance to strike there, because both have a kind of valid argument, I would say. But how do you strike that balance? Because it was quite difficult to do.
Yeah, well, I just refrain from expressing my opinion on that particular the incident, because I serve on the board of the Danone's mission committee, and I have my personal opinion on the Emmanuel's performance and a respect for him, etc. But the way I saw that was, in the capital market, we just cannot deny the existence and sometimes benefit of having short-term investors, even traders, right? Yeah. These days we now have the machine, the trading at the nanosecond cycle, right? And as the other major, the participant of the capital market, I don't deny their roles, and also sometimes their benefit to the whole capital market.
Right.
But on the other hand, sometimes they goes too far, and sort of a short-termism, like just a kind of a dictate the way the company is operating, and that's where I think the governance should kick in, trying to manage it. And also, I see the role of real long-term asset owners, like that's the behind the GPIF decision to suspend the stock lending, because we are the biggest and a literally long-term investor with the 100 years investment time horizon. And at the peak, like a 60-70% of our stock was lent to somebody who probably using to put the short-term pressure on a company. So I think it doesn't make much sense, because on one hand we are just trying to promote the long-termism and the focus on the long-term issues, but on the other hand we actually don't have the ownership most of the time, right? So
that's quite a good point. I mean, obviously you mentioned you sit on the board of Tesla, and the Tesla boss Elon Musk has also been critical of short sellers, and so that's an area of common ground. I completely get your point.
Against the short sellers maybe a little bit different from the reason I was against short seller, because I was the owner of the Tesla, as institutional owner of the Tesla, so they have a bit different perspective. But
fair enough. But I suppose the wider point is, can short selling be kind of ethical if it unearths, it can, unearth a fraudulent company, for example, and kind of make it, and it can do a good in that way, perhaps. But do you think that doesn't necessarily outweigh the wider problem of too much short-termism?
Well, let me respond to your question a bit, the sort of like different ways. First, I think what is important for GPIF was whether our the stock lending practice was consistent with our other, like a stewardship principle and etc. So it's nothing to do with whether they are ethical or not, right? So that's one thing I just want to make it very clear. And the other things which bothers me was there's basically no transparency in that practice. Most of the time I couldn't even tell whether GPIF stock today exists, who's holding that. It was not transparent. So those kind of things that made the real reason why they reached the conclusion we probably need to suspend it to see how it develops. But I mean, short seller can be ethical or whatever, because to be honest, most of those short sellers, their holding time frame is too short to reflect whether the ethical behavior or non-ethical behavior. Right. They are just trying to make a financial investment, which is fine. And to your point of, and also I received that question a lot when we announced our decision was, short seller is effective to penalize the company who's not doing right things. And my argument is, maybe, but that they will be penalized even without the short seller anyway, because if you say if the company involved in a fraudulent the business practice, we don't need a short seller to penalize them, because that company's stock will penalize anyway, right? Okay. So those kind of things that there's not. I think it's probably not even appropriate to discuss the ethical behavior with that kind of short period of the holding time. But the longer your investment horizon or holding period becomes, the more relevant to discuss those kind of things.
Yeah, fair enough. Just in terms of sustainable investments and investors making those decisions, do you think investors have enough data and understanding of what is a sustainable investment and what isn't, in order to kind of make those decisions? So in the European Union, we've got this taxonomy thing which it aims to kind of do that for you, and kind of say this is green, this is not. What's your view? Do you think there is enough clarity out there at the moment?
Well, I think 4 or 5 years ago, when I receive that pushback from my own team or asset manager or whoever saying like, oh, Mr. Mizuno, there's a risk of greenwashing, risk of like ESG washing, and etc. I usually try to push them back saying like, hey, come on. First of all, you need to agree those are important, and then you worry about washing, right? Because interestingly, most of the, usually the people who use the greenwashing or ESG washing or lack of information as a counter argument not to integrate ESGs are not the believer of ESG to begin with. So I used to say like, you are using that as an excuse not to do that. But now, as I said, that battle was over. Everybody says ESG is relevant, ESG is important, ESG is critical. And then now they are saying, okay, we are ready to do that, but how can we do that? And then this is the debate on the lack of information, lack of standardization has its merit. So I think now we probably need to focus more on, having more standardized data set, more comprehensive data, and also creating a standardized reporting framework or like ESG matrix. Because now I think the people not arguing whether they should use it, and now they are saying like, hey, we need something which we can rely on. So I think that now becomes more relevant. And the one thing I'm trying to intervene in my special role as a special UN special envoy is particularly about climate change. I believe in a free economy. Actually, I don't really like regulator, just believe it or not. So I think in many cases, free market usually come up with a better solution than regulator in many, many cases.
Right.
And this time I'm calling for regulatory intervention in the ESG matrix and the disclosure standard because we just don't have time to wait for the market to work out. Right. So I think when it comes to the, people talk about ESG matrix, but I'm more specifically concerned about and also crying for the government of regulatory intervention at the integrated and also high level, like a G20, COP26 level, to really agree on a standard for those disclosure and investment matrix, because we just don't have to wait for the market to sort it out, which I think will sort it out someday.
Do you think there's a chance that we'll get something along the lines of what you want at COP26, later this year? Do you see good signs that something will happen there?
Well, we are focusing on, I'm working together with Mark Carney, and I advise the Japanese government to continue to be a champion of the TCFD disclosure. So Japan now, I'm very happy to see like Japan has the most number of the TCFD recommendation supporters. So I think the first step is, and also Japan is now finalizing the revised corporate governance code, and which is going to have the sort of comply or explain requirement on the TCFD disclosure. So I think that my focus so far is until the COP26, together with Mark Carney, is making TCFD is sort of quasi mandatory climate disclosure framework, and I am still hopeful that we will get there. But the climate is something we really need to get that as quickly as possible, and it's probably now a lot of people understand this is not just ethical or like the choice, moral choice. People started seeing the actual the physical impact on their portfolio. So again, a lot of cases like what people think as is a sort of like a value statement. Once the society created their consensus on that particular value or particular items, that will become the financially the relevant information, and then the time difference getting shorter and shorter as the people have the general agreement on the ESG, the ESG integration. So, but the climate has to be the first one.
Okay, well, listen, I think we're going to leave it there. So many thanks, Hiro. That was really interesting. I think it was also an excellent way to round off what has been a fascinating 3-day summit. So back to you, George, to formally close Ethical Finance 2021.
Thank you.